Private equity ETFs open up markets that were closed to retail investors. But are the investors really getting the access they think they're buying? This is Inside ETFs, and we're talking private equity. For America's most hyped growth companies, going public is going out of fashion. Big names like OpenAI and SpaceX are not necessarily planning to IPO anytime soon. Instead, they're tapping private equity markets. And for some ETF providers, that's an opportunity. Private equity ETFs aim to give retail investors greater access to private markets, but they own public firms that manage private equity rather than the high returns deals themselves. So what access are investors really buying? Patrick Kennedy is a founding partner of All Source Investment Management. Patrick, retail buyers think they're getting exposure to private deals here, but that's not exactly what's being offered, is it?
Private equity has been a very powerful asset class amongst institutional investors for some time. The U.S. Cambridge Private Equity Index has outperformed the S&P 500 every year for the last 35 years. So I understand why retail investors want access to this asset class, but it comes with some big risks. One of those risks is it's illiquid, right? So the very nature of private equity is investors are hoping to receive what's called an illiquidity premium, which means in return for tying up my money, I want a better risk-adjusted return than the public stock market. When you try and put that within an ETF, it doesn't work because the very nature of an ETF is providing liquidity, daily liquidity, and transparency. Yet we're seeing big alternative managers push to do just that. And the reason why is the US market, or excuse me, the global ETF market is about $17 trillion. So it's an enormous opportunity for private equity managers to go after if they can do this right. The biggest challenges they're having, though, is getting an illiquid asset within an ETF. What they're doing today is rather than offering the private deals or the illiquid deals within the ETF, you're seeing private equity ETFs buy shares of the actual managers themselves. So buying shares of companies like Blackstone, buying shares of companies like Blue Owl, so on and so forth. You're not getting the actual private deals which these companies manage and are so lucrative.
In other words, those ETFs don't map the returns of the assets that they're aiming to track.
Correct.
So why should retail investors then buy into private market ETFs? What's the advantage here?
Yeah, so the company themselves are actually doing quite well. So when you look at Blackstone, when you look at Blue Owl, they're the managers of these huge private market funds, and they charge a hefty fee to manage those funds, typically 2 and 20, which means they're getting 20% of the profits they generate and a 2% management fee. So by buying the shares themselves, you're getting a small piece of their balance sheet. By doing that, you're getting some access to private markets. The way we would like to see people get access to private markets is obviously by direct deals. But if you want to do it through ETFs, the best way to do it, in our opinion, is go after a private equity ETF that tracks the actual managers, which is going to give you good beta to their success.
Retail investors, especially younger people, clearly want exposure to hyped private companies like OpenAI, SpaceX. How are they changing this market? And do you think they really understand what they're buying into?
Yeah, so the way they're changing it is they're providing an opportunity for alternative investment managers to go after. You're hearing a lot of talk about tokenizing private deals and putting those tokens within ETFs. My personal opinion is that's just so dangerous, right? Because you're creating a lot of leverage on an illiquid asset by doing so. When you're looking at a mutual fund, it's like playing checkers. When you're trying to pick an alternative investment manager, it's like solving a Rubik's Cube, right? There's so many more variables that go into that equation. And there's a lot more information that you need that are only available within the private markets to make the right decision. So by buying a private sector ETF that actually tracks private deals, I think is quite dangerous, simply because retail investors are not given the same information that institutional investors are given on that deal, at least today. And on top of that, you're trying to put an illiquid product within a liquid wrapper, which is never a good thing in my opinion.
This seems to be an unstoppable trend, though. You said public and private markets are converging and ETFs are the bridge. Where is this bridge taking the investment industry? What's next?
Yeah, so the way we've seen it done successfully is within BDCs, business development companies. So that's an actual stock that's traded on the stock exchange that owns debt, right? So there's much more information on that debt within the company. So within some of the ETFs that track those BDCs, you have information readily available and it's liquid, right? So you're getting a much higher yield than the market. You're not getting some of the volatility benefits from holding private debt, right? So private debt is marked quarterly. Therefore, you're not seeing some of the volatility you see within the public market. In the public market, if you own an ETF that owns this debt, obviously it's going to come with some volatility, but you're going to get the yield that you get within the private markets. So private credit has figured out a great way to do this, which is have the BDC company set up, provide the same sort of information that you would on any public company for that BDC, and then wrap those within an ETF, right? That has turned out quite well for public investors. Again, you're going to deal with volatility, but you will achieve a higher yield, which is exactly what you're looking for within the private markets within that space.
That was Patrick Kennedy of All Source Investment Management. Don't forget, you can watch more videos on Reuters.com.